Welcome back to the channel. I hope all of you are having an amazing day. So today's video I'm extremely excited about. We have so much to talk about, all the way from Bitcoin's short-term price, inflation, oil production, and the effect that's having on the markets, sovereign debt crisis, bond yields. This episode is going to be one of the most in-depth that we have, and I'm going to do my best not to ramble, but it is going to be a little bit of a longer video, so I do apologize for that. Now, the chart that we have pulled up is the Bitcoin 4-hour chart, and it's extremely important that we look into this. But before we actually do, we have to look into a couple other charts in order to get the context for this. And of course, timestamps are down below for your guys' convenience. And again, check in the description down below, as we have a newsletter where we deep dive into this type of stuff on a weekly basis. And if you could check that out, that would be amazing. Now let's get into it. So this chart is basically going to summarize the entire video. To put it short and sweet for you guys, these are the 4 bear markets for Bitcoin, just looking at them. Now, this is from the peak, and this is coming all the way down. We are currently the green. We are only right here. Not only do we have more time in the bear market, we also have more downside compared to all of these other bear markets. And on top of all of that, we are in the worst economic state possible in this bear market. So in my opinion, I try to be as objective as possible, but sometimes you just have to look at what's going on and understand there is more pain to come. Now, as I'm making this video, it's currently October 13th at 5:30 a.m. So by the time this video posts at 9 a.m., the CPI data will already come out. So it'll be interesting to see how the data plays out according to, what I think is going to happen. And then we can kind of play that back and see, the prediction of what's happening. But it's going to be interesting. So by the time this video comes out, CPI data will already be out. So I'm not going to talk too much about it. But basically, these are the two main things that we're looking for: core inflation and CPI inflation. Core is what the Fed looks at. CPI is basically what we look at. So we're hoping that the numbers come in a little bit softer, but they may not. Now, the reason that I don't think the CPI data or inflation data is going to come in a little bit lower is because PPI came in yesterday. Now, this doesn't have the same effect it does on CPI because this is for producers. So the producer doesn't really meet the end customer and affect them in terms of inflation. But this is a good gauge to kind of look into the future a little bit. And, if producers are experiencing increased inflation, odds are we probably are going to as well. So the consensus and forecast was that it was going to be 0.2%, and it came in hotter at 0.4, which doesn't seem like a high rise, but again, it is showing inflation is continuing to go up, and that means odds are CPI data is probably also going to come in hotter than expected. Now, not only is that bad for Bitcoin and the entire market, not just crypto, but stocks as well, any risk asset. When you look at Bitcoin's future open interest, this is showing that massive amounts of volatility are in the market, aligned with a CPI data incoming, in the next couple hours. We're going to see insane amounts of volatility. As you can see, volatility and open interest have been rising, and yet Bitcoin's price has been consolidating. Now, over the past, basically, whenever a risk asset like this consolidates, just like it does over here, it makes a massive move. Consolidates, makes a massive move. I mean, you could literally go into the charts and you can see that whenever price is coiling up or there's consolidation, and then you also lay that over with increased volatility, there is going to be a massive move in the market. Now, is it to the upside or the downside? That's what we need to get onto the charts to look at. So right now we're on the Bitcoin 4-hour chart, and this is going to be a little bit more of like an in-depth type thing. So I'll try to keep it as simple as possible and, help you kind of walk you along the road. So the first thing that we have to understand is that there's increased volatility in the markets, which basically means that short-term traders are waiting for this news to come out, and they're kind of betting, is it going to be good? Is it going to be bad? Now, the one thing I do want to urge you guys is, if there's one thing you could do in your investing career, I don't like offering financial advice, but this is one thing that I think you guys need to understand. Don't short-term trade. Don't be day traders. I've tried it myself. I've seen many other people try it. It's basically just gambling in the markets, and the hardest thing about it is that even if you get the direction right, you also need to get the timing right. And short-term trading is honestly just a gamble out the day. It's basically like going to Vegas and testing your luck, except there's more market manipulation in the markets than going to Vegas. So the first thing we have to understand is that short-term traders are hedging their bets, right? There's open leverage and there's open interest that is extremely high. And we've had consolidation, which means we are in turn for a big move. Now, there's two things that can happen. If inflation comes in hotter, it's going to show the Fed that we need to continue to these rate hikes, and it's going to send the markets down, which is bad, right? Because obviously we don't want the markets to go down, but it's going to happen. If they come in softer than expected, what we could see is some market manipulation. We could see some upside in the markets. Okay, let me make this blue for our convenience. We could see some upside in the markets short term, because we could be taking advantage of that short-term leverage liquidity. So what could happen is the market goes up, margin calls or takes out the stop losses of a lot of these short sellers because the open interest is so high. So you've got a lot of people betting that the market comes down. If the CPI data doesn't come in as hot and it comes in softer than expected, we could get short-term volatility to the upside, margin call a lot of these short-term sellers anywhere in between these levels. So maybe somewhere at 20,000, 22,000, or even 25,000, right? All possible levels. And then eventually what happens is that even in the short term, that volatility is going up. In the long term or the medium term, in the next couple of weeks, we are coming back down. Now, I don't want to be subjective and tell you, oh, this is definitely what's going to happen. But as we continue this video, you're going to see that a sustained rally to the upside basically is not going to happen, and downside is inevitable. So no matter what happens, I think short term, if readings are bad, we come down. If they are good, we're going to have short-term volatility to the upside, take out some of that short-term liquidity because of the open interest, and then eventually still come down. Now, that's just my prediction. It'll be interesting to see what happens because I'm making this video before CPI data, and the video will actually come out after. So it'll be interesting for you guys to pair that up with what I'm saying right now and then what actually happens. So not only have we talked about the problem of inflation, we've also talked about the problem of a short-term open interest in the markets and the volatility to come. But another thing we have to look at is that whenever inflation is above 5%, the only time that it actually comes down is when the 10-year yield is actually above inflation. Now you can see when it's green, that's when the 10-year yield is actually above inflation, and typically it is good because that is what pushes inflation down, because interest rates are rising and people are putting their money into the economy and people are kind of lessening their spending, and so it sends inflation down. Now, if it is not, you can see when inflation is above the 10-year yield, like it is over here, it sends inflation up, right? Whenever it's above, you start to get these peaks. And currently, inflation is at 8.25% when the 10-year yield is far behind at 3.8. So yes, we have an extreme gap, and that's what's causing this massive rally to the upside. Obviously, there's a lot more factors as well, but until we actually either get 10-year yields to rise and catch up or inflation to come down, we can expect just a continual rise in the inflation. And until this actually swaps and the yield goes above the inflation, then we can actually see some downside coming. And a lot of this comes off of the heels that 10-year government bond yields are not as safe as they used to be. Every single country is experiencing volatility and increased yields. Now, this is really bad because typically yields are a place to put your money if you want them to be safe, right? If risk assets aren't doing good, you put your money in bond yields because you trust your country. Well, what we're seeing is a lack of trust, and there are no outside buyers coming in. And so what happens is, as the government continues to do rate hikes, quantitative tightening, they want to bring inflation down. At the same time, they also have to continue to print money and buy their own bonds in order to sustain the bond market. So there's a lack of trust and there's a lack of liquidity. And so even though they're trying to fight inflation, they're creating inflation because nobody is buying the bond yields. And just to kind of prove my point, if you look at the US bond market volatility, we are currently at panic levels. We're at levels of when the pandemic hit, the 2008 great financial crisis, and the dot-com era. And it looks like we can continue to go up at this point, but as of right now, the VIX is getting at some really insane levels, but at the same time, we do still have some momentum to continue to go up, which is actually the scary part. Well, actually, you can see the VIX is right here, but it does have that potential to continue to go up. And once we actually reach the 40-point level for the VIX, that's typically when a lot of recessions and a lot of capitulation happens in the markets. So we're getting pretty close, as we're at 33 points currently. And to just kind of put the nail in the coffin and move on to the next thing, you can see that government bonds have done the worst in basically our lifetimes. If you look at the other times that they've done this bad, I mean, we're looking at times of 1721 back here, 1865, end of the Civil War, and then 1920s. Like, we know that these are extremely bad times when the bond market has done as bad as any time in history. And this has only happened like 4 or 5 times in the past couple hundred years. So is this just showing you how bad the bond market is, the sovereign debt crisis is going, and that there's still more volatility and room to the downside. And so now we've talked about inflation, the sovereign debt crisis, bond yields, no liquidity, volatility incoming, and now we have to talk about oil, because this is also going to have an effect on the market. Now, typically it usually doesn't, but with things happening right now and the timing of everything being perfect, this is definitely an important topic to also cover. Now, I don't know if you're familiar, but OPEC, they're basically in charge of oil production. These are like really big oil countries like Iraq, Iran, Saudi Arabia, countries like that. And so basically the United States produces, let's say, like 19 million barrels of oil a day. But yet we use more than we actually make. So we have to get our supply from other people. And so what they do with their oil and how they export it to us also determines the cost of gas. Because if they don't give us more, they lower the supply, we have to pay more for it. And that's exactly what happened. OPEC Plus basically said that they're going to sharply cut off the oil production in terms of them wanting to keep some for ourselves. And now this threatens a push to the levels of a global economy recession. And, basically they're like, hey, we understand that the world's kind of messed up right now, and we want to keep some oil for ourselves as a reserve and a security blanket. And we're not going to give as much to the United States. That is raising a ton in the price of gas and is continuing to skyrocket. Now, again, this is also in line, and I don't want to talk too much about politics, but it's in line with the midterms. And we do have an oil piggy bank for extreme emergencies, the worst case scenarios. But yet our government and Joe Biden are dipping into our oil piggy bank, basically because midterms are coming up. And the worst thing that can happen is if oil prices and gas prices continue to rise during midterms, because that's going to be a massive talking point on midterms, and that's not going to be good for them. So what they're doing is they're relieving short-term pressure by taking our oil reserves. As you can see, we've never done that before. We've been trying to, since 1982, build up our oil piggy bank just in case of emergencies, but yet midterms are coming up and they want to look good in terms of the media. And so what they're doing is they're taking a ton of the oil, temporarily fixing the issue, but yet taking away decades of work just for a couple weeks of relief. So as you could see, the world is absolutely just messed up at this point. I mean, there's so much going on, and there's so much left that we need to kind of unravel in this story. The Bitcoin bear market and the entire bear market of all the crypto and stock assets, risk assets really, they're just beginning, in my personal opinion. Now, in the short term, I wouldn't really care about what happens, because when you zoom out and you look at the long term and you look at everything we just covered and so much more yet to uncover, it looks like we still have so much more room to the downside. And personally, for me, even whatever happens, if we get a dip to the downside, if we get that short-term volatility and back down, I think we can go even lower. And that's why I have this accumulation area. This is like the sweet spot of where I think Bitcoin's going to go. Can it go lower? Absolutely. Can it never even hit this? And maybe we have hit the bottom at this orange line. Absolutely. But in my personal opinion, is trying to be as subjective as possible, which is very difficult in these times. I think this is definitely a sweet spot for me. This is a really amazing spot to get into Bitcoin. I just see so much more downside coming in all the markets because of what's happening. And we've had over a decade of prosperity in the risk asset markets. And now what we're seeing is we need to kind of reset, get back to reality, and basically fix all of these issues that we've had on a fundamental level. So that's everything I have for this video. I can continue to talk on and on and on, but that's for future videos. So if you guys found anything educational in this video, if you liked it, if you made it this far, thank you so much. And I do appreciate you. And if you guys could do me a favor, subscribe down below, like the video, and also leave in the comments your thoughts of what we could do better for next time and what you liked of this video. Till the next time, see you guys then. Peace.